Okay, let's look deeper into the RSI. And the RSI gives us another way to confirm the direction of the trend. There are many more indicators out there that you could use, but I like to stick to the simple ones, which makes it easier to grasp the meaning of how to use them. Before you even use an indicator, it's a great idea to know what you're using them for. The RSI is to be used to identify overbought and oversold conditions in the market. When price is above 80, it's considered overbought, and when it's below 20, it's considered oversold. You may also use 70 and 30 as well. So 70 would be overbought and 30 would be oversold. So if you're using 80 and 20 as your RSI, it will set you at a less extreme position, which means you're more safer. If you use 70 and 30, well, you're kind of testing the waters a little bit. So you have to ask yourself, am I more aggressive or more conservative when it comes to trading? And I need you to understand something. Even though the RSI shows you overbought and oversold conditions in the market, that does not mean that the chart will actually be a buy or a sell at that point. That's when you take everything that you've learned so far and put it into consideration before placing a trade due to the RSI. The RSI can also be used for divergence, which also means that the price chart in the RSI may tell a different story. Let's take a look at the bullish and bearish divergence example.